was kind of the first thing I thought of.
Your conference is being recorded.
I get a good way. It's like a random guy.
You're like, oh, I see. Heads or tank or something. Well, thanks for carving out time. This should be easy for you because we're going to ask you to talk.
Stump the chump.
All right. Colleen, she joined our team, product marketing, then the broader marketing team about a month ago or so. And Maureen, we're actually recording this with Maureen. She can't be here today, so she wanted to have the benefit of that. So it's not a problem. But insurance is a big deal for us, right? It's your life, but it's a big deal for us this year. And I know you've talked with Garrett about certain campaigns and so we wanted to talk a little bit about one component of what product marketing is working on with Garrett and Maureen, and that is case studies. So we're looking at doing more broadly case studies for our quant pillar, our multi-asset, and our liquidity pillar, and kind of structuring the case study and then trying to come up with a solid template. You're kind of our early one on that, but where we have a solid example, solution, results, all those things defined. And given the priority of insurance, we thought we'd start here today. So that's the goal, case study. I guess a couple things that would help to me. I'm familiar with insurance companies, probably 2 levels down. I know you've lived it for a while, so maybe we'll start with just a little background on kind of the types of insurance company and the investment challenge they're facing. Is that okay?
Sure.
Okay.
So I divide the space primarily into 2, and if we're talking about the balance sheet, there's kind of the large mega life. You know all their names, primarily on the East Coast for the most part. You know, there's a big whale out west with Pacific Life, but you have these massive life companies that are tremendously fixed income driven, huge fixed income, larger active fixed income than we have. They'll most oftentimes have their own fixed income team. This fixed income investing is driven by the way they run their business, so they know what the liabilities are on the life insurance side, right? Life tables go back to the 1600s. They know on average exactly when on average we are all going to die. And so they play that big, get the big game and play the numbers game, and then they can run their asset, they're really asset liability matched, if you will. And then they'll take their surplus and buy really long assets out in the marketplace in the private space, right? So that's why you see John Hancock's name on every building, because Hancock was a life insurer that went around and bought a bunch of long buildings without those long duration, income focused, real estate focused assets, or where they'll spend their time in that life, puts its name on buildings and all that. They tend to not be so big in the equity space. Equity is also very volatile in the minds of insurance regulators, and life insurance companies are supposed to be there after we're all gone, the banks are all gone. So it'll be the cockroaches in MetLife after the war, right? So that's kind of how they regulate. That's kind of their mindset. So they're asset liability matched fixed income, or really long private asset classes, and then the rest of the insurance world where we spend. So those groups have little use for me and us
because they're big in-house folks.
Big in-house folks. Now maybe they have use for some of the more recent nuanced 50 South stuff, bonsai. Chinese PE. There's something unique, interesting around the edges. In fact, Northwestern Mutual Life is in bonsai. Right? We could bring them Sequoia Global Growth 3. Even Northwestern Mutual Life couldn't get into that on their own. So they saw value there. But they see no value in a general fund of funds or approach there. The other side of the world where we do add value, I spend the majority of my time, is with the property casualty insurance companies and the healthcare space. So I'll put the PNC together and then know that health is pretty similar as well. So they loosely have liabilities, right? Their liabilities are not nearly as predictable or accurate or precise as the life insurance side, right? So the life insurance industry knows on average when we're all going to die. State Farm has a pretty good idea of when your house will get robbed or the tornado will hit, but you know what I mean? It's just a lot looser, right? So yes, they kind of have liability-driven investment, but it's very loose, and they're willing to mismatch that intentionally, because they know by mismatching it, for instance, on the fixed income side, by stepping out a year or two in duration, they can climb the curve and they can get more yield, right? They're also heavily fixed income driven, both by regulation and by business type. They also focus on something, and life insurers do as well, but they focus on something called investment income or book yield or book income, right? The belief being that a fixed income portfolio that has a yield or income component to it is repeatable and brings certainty with it. So they like looking at that yield number where they don't, where they heavily discount a total return framework. So they say, well, that was manager luck one year. The manager can't repeat that every year, right? Or that's, it's just kind of not a repeatable bet. So they're very focused on book yield and yield-focused strategies, traditionally. They're also taxpayers. Life insurance companies are not taxpayers on their investments. P&C and healthcare companies predominantly are. And so they're very focused on, so P&C and healthcare company kind of looks like a GFO type client, very focused on taxes, at least from an investment thesis standpoint. Focus on taxes, focus on income. Right, so they hate paying, and they're conservative. They hate paying taxes, they're focused on income, and they're 90-ish% fixed income. They have a lot more flexibility on the other asset classes. Because their regulators realize that they're not so asset liability investment driven, that they are taking an intentional asset liability duration mismatch. And that the pool of assets is really there to pay in case something happens. And so therefore they invest more in the equity space. They're interested in equity solutions. They love TAE for the taxable ones for all of that reason, just like Wealth and GFO would like TAE. They prefer dividend-focused strategies, and that's why QDF was a big winner early on, because remember where the bond market plummeted to, and we could show up with leveraging their equities and do a dividend-focused strategy. We've all known that dividends has been a laggard for the last decade, so they're ready to trade out of that. While they appreciate the concept of dividends, they know the reality of it has been underwhelming. So they're
really the performance, or actually now that the yield has kind of caught up to 2.5.
Both.
Okay.
Yeah, both. Yeah. So yes, it was great at one time when you could bring a 2 to 3% yield in your equity portfolio, right? That was certainly better than your bonds. So you're right, bonds have kind of caught up. Number one, and then number two, while they did like that, they also want their equity to keep up, and dividends while providing that dividend did not keep up. The factor underperformed.
Yeah, it returned it.
Yeah. So I'd say while they're very active on the fixed income side, almost by requirement, they're doing TAE only on the fixed income side, which means lot control of the individual lots of the bonds. They manage their unrealized gain losses because of either for tax reasons or for book accounting reasons. We are rare in the industry that we can do that on the equity side. I think many of them say, I'm going to manage my realized gain losses on the fixed income side, and on the equity side, I want beta exposure or I don't. So it's either risk on, risk off, or gas pedal on, gas pedal off. And if I am going to go active, at least traditionally, they'd say, well, then I want a dividend strategy because I appreciate all the things that dividend can bring to the table. So that's kind of setting the scene, if you will.
A couple questions.
Yes.
So life insurers, we mentioned the big ones. Are there, and that they're largely in-house managed, right? Are there a second or third tier that do outsource some of those functions in which we could participate, or is it largely the other things going on with the way they run their business where we don't have a lot of opportunity to compete for, even if they were outsourcing it? So just
So there's kind of a second, it falls off a cliff. I mean, it's hundreds of billions. And then you get in like single-digit billions.
Oh, wow.
I mean, it just falls off a cliff. And all those smaller ones they're struggling. It's like recapitalizing. So yes, they do outsource, but they have no equities.
And we're talking about life.
Yeah.
Okay.
Yeah.
So as you come to property and casualty,
all of them have.
all of them have.
Right.
Okay.
State Farm is one of the largest financial institutions in the world. And then, name your favorite Wisconsin Mutual that no one in this room's ever heard of. Right. And we like them both. Obviously, we play different roles.
Question about that, because there's different types of structures of the firm. Does that play in at all, except knowing kind of how a mutual ownership versus a stock ownership versus the property. Does that play into how they're managed or how?
Yeah. It can. So mutuals retain all their earnings, where the stock-owned companies are run a lot leaner. So with all this retained earnings, it builds overcapitalization, which means they have quite a bit of surplus, which means they can play even more outside of investment-grade fixed income.
Okay. All right.
But I think it would be a mistake to say that only the mutuals are the ones big outside investment-grade fixed income, and if you're stock-owned, that you wouldn't be. I would say you would have a tendency to. Because over all those years where they were profitable, a mutual company didn't dividend anything out to stockholders. There's no share buybacks. Right? All that just stays inside. And so, we have a free cash flow problem, or too many assets to bury you to make bad investment decisions, or management finds other ways to creatively destroy that capital over the years.
And you guys jump into questions. Okay, so anything else about kind of the companies or how they're structured investment-wise before we start talking about their pain points either?
They'll almost always outsource on the equity side, because if they're multi-manager, if they're fully outsourced multi-manager, of course they're outsourcing. Even if they're internal on the PNC side, they're either going to have somebody who buys a bunch of beta ETFs, right? So they'll have something between a mixture of, I just buy kind of iShares for, again, that gas pedal brake